Markets starting the week on an upbeat note while we're heading into a seasonally good period for stocks. There are a lot of events happening in the next week. We got earnings, the election, and the Fed decision, just to name a few, which will be key drivers. Well, joining us now is Eric Wallerstein, Yardeni Research Chief Market Strategist. Eric, it is good to have you on the show. I want to start maybe with yields, Eric. I'm curious because you look at the 10-year, we backed up near 4.3. I'm curious, Eric, what do you think the message is that yields are sending us right now? And is there a level you'd be watching where you think, okay, that's when we could see a squeeze on the equity market?
Yeah, I think the run up from around 3.6% just as the Fed was cutting all the way up to 4.1, 4.2% was really a combination of two things. Economic data came in way stronger than a lot of people expected. We had upwards revisions to previous months. We had stronger GDP, stronger GDI. We had a really good payrolls report in September. And then we also had the Fed cut by 50 bips. So I think the message the bond market is sending is the Fed did too much and too soon. And then I think, a lot of people are equating this to rising odds of a Trump victory in just a week or so. I think that's a little bit of, nothing changes sentiment like price. I think a lot of the run up in yields, at least to 4.1 and 4.2%, had to do mostly with economic data and the Fed. I'm kind of hesitant to chalk it up to rising odds of a Trump victory, given, it's still kind of a coin flip. And, it's mostly an economic data story.
Eric, I wanted to ask you about the rising odds of a Trump victory. There was a chart, Lori Calvasino over at RBC Capital Markets has been tracking this for a couple months now, just simply looking at the S&P 500 and the odds of a Trump win, right? I think there are a lot of factors, like you just said, that maybe go into that light blue line there, moving the S&P 500 higher. But some have tried to say, at least at net, the market has leaned toward pricing in a Trump win versus pricing in a Harris win. Do you think we're at that point yet? We're headed into next week. That feels like where the market's positioned, that it's positioned for a Trump win, and a Harris win would maybe prompt a surprise to the downside?
I don't think so. If you chart ice cream sales and crime, they look like they track as well. I think a Harris administration would be at least pretty similar to the Biden administration. It's, she's obviously the vice president. Her economic plans there's worries about a fiscal deficit, but, recent estimates obviously have Trump's plans being even more worrisome on the fiscal side. So I think the market would do fine with Harris. I think the market would do fine with Trump. I don't think the stock market would, is really pricing any presidential odds. If you think about earnings season, it's been going pretty well. Big banks did well in Q3. We should get above 3% year-over-year growth for the third quarter, which we get later this week. So, things look good on the earnings side. Things look good in terms of economic growth. So it makes sense that the stock market, is kind of around record highs, especially given the Fed is easing into that really hot economy. So I don't think it has to do with the presidential election.
So Eric, let me ask you, so if the economy looks decent, earnings look decent, what worries you and Dr. Ed right now? When you get together, you discuss your wall of worry, what comes up?
Yeah, the biggest risk for us, at least in terms of domestic growth, has been geopolitics for a while. It's still just a 20% outlook in terms of our kind of probabilistic scenarios. But today, I think a lot of the enthusiasm for cyclicals had to do with Iran and Israel's tensions fizzling, or at least, Israel's attacks on Iran not hitting oil fields. Oil dropped, 5+%. Financials and materials both did very well. We also had some mix-up in the Japanese political scene, but it looks like, investors are kind of hoping the conservative parties figure out a way the conservative parties there are really in favor of easy monetary policy. So the Nikkei ran up, the yen weakened. I think broadly, we're just seeing fewer risks to global growth, and the U.S. has been the strongest economy to date and for the past couple of years. So I think there's a big risk that the next president or the next administration really continues to blow out the deficit. But the bond market's pricing that in. And, as the yield kind of fell towards 3.6%, we were saying, we don't think this lasts and it's time to short bonds. And I think, 4.25%, maybe even 4.5% makes sense given the economic fundamentals. I'd say fiscal concerns and the geopolitical landscape, but, so far, nothing too major, hence why we're at record highs.
Eric, I'm curious over the next week. We've talked about it a little bit here. Plenty of headlines to look at, right? You could go big tech earnings. You could go all of the economic data we're getting this week. You have the election. You have the Fed meeting next week. What do you think is going to be driving markets here over the next week? Is it the fundamental story with earnings, or are we going to be a little bit more macro focused?
Yeah, I think earnings will probably be in the driver's seat, barring anything unexpected. There will be more chatter about the election. But I think in terms of Q3 GDP, expecting really strong growth. If anything weird comes out there, we'll see what has to, we'll see what happens. We're expecting real incomes and real spending to rise about 0.5% month over month, which is really healthy and kind of tracks with that strong growth. We get the payrolls report on Friday. Monthly payrolls have been huge for the past several months and even year, but we're going to get this one muddled by worker strikes, Hurricane Milton. There have been some layoffs by Boeing and Stellantis in terms of the auto companies. So it's going to be hard to get too much of a read from there. You'll probably get a little uptick in the unemployment rate, slower payrolls growth, but we think the labor market still looks pretty good. I mean, the layoffs have been due to workers asking for exorbitant pay increases, not because of some broad cyclical slowdown. So, even if payroll growth subsides a bit in November, we expect it to or subsides a bit in October, we expect it'll rebound through the end of the year.
Eric, how do you think the market would take a very weak print on Friday? There are some reports out there that this could really distort data, right? So at least the headline numbers do not look great. Do you think that's something that the market can accept?
Yeah, I know Bloomberg Economics is calling for a negative print. I mean, they've been wrong on the labor market for like 2 years, calling for a recession. So I don't know, maybe they're right this time. I don't think it'd be a huge deal. I think the Fed is uber committed to being dovish. So I think, based on some recent Fed speak, there's a chance that given the bulk of economic data we've seen, some of the more hawkish members get a little more sway at the upcoming meeting. I don't think a super weak payrolls report would be that concerning unless it looked like it was really cyclical sectors that were seeing layoffs. I don't expect that. The big risk, I guess, if there's a GOP sweep during the election, I think a sweep, and it's much more likely to be a GOP sweep than a Democratic sweep, gives you that kind of like rubber stamp approval, right? You can pass everything you want. But again, it's a really murky congressional makeup, right? Like not every Republican and not every Democrat votes really party line. So, I'm not really worried about this payroll report. We're watching it, but it's going to be weak. We'll be waiting for the next one. Continuing claims rising a little bit. Initial claims don't look too bad. So, labor market looks okay.
Eric, great to have you on the show today. We did a lot in a short period of time there. Thank you.
Thanks, guys. Have a good one.